Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
All right, guys, welcome back to the Winner's Playbook. I am Josh Lee, and I am joined with Kev Tran of Kev Tran Group. So not here with my usual co-host, Steve Sloan. I'm actually here with Kev, who is a buyer's agent. Kev, welcome to the Winner's Playbook, mate, and how's things on your end?
Hey, Josh, thanks for having me on. I listened to the podcast, so feel very special to be on today. Mate, everything's pretty good at the moment. We are going really hard trying to buy properties for clients. That's the hard part. I say to people all the time, is getting good quality assets at the moment in the areas that we're buying in. So that's the challenge. But yeah, love what we're doing.
Yeah, and if we kick off, Kev, we've been working together for a good couple of years now. I'm obviously very familiar with what you do and what a buyer's agent is, but can we maybe just start and just tell us what actually is a buyer's agent? How does that differ to a real estate agent? Like what do you guys actually do?
Yeah, absolutely. So to kind of take a step back, a buyer's agent technically in terms of qualifications is same license as a real estate agent. Right? So we're estate agents, and but the crucial difference is we represent the buyer as opposed to the seller or the vendor. So whilst a real estate agent may or may not be friendly and charming and all that stuff, may help you make the purchase, they are looking after the vendors or the seller's best interests. They'll try to extract the most out of you with pricing. They may hide certain aspects of defects or anything like that about the property. So the buyer needs to really do that themselves. Many people will engage a buyer's agent to do that. And then specifically, like any other profession, you've got specialties or like niches. Like for us, I should say you've got ones that look after owner-occupier purchases, family homes. Some are area specialists. They only do certain areas. Or what we do is we're investor focused, and also we don't have bias towards location. So we're searching across the whole country.
Yeah, and so that's interesting because I remember early on when I was actually looking around for a buyer's agent to be comfortable sending clients through to with our business. I met with quite a few that would just work in suburbs and they didn't ever look outside of those suburbs, and it never really made sense to me in terms of if you're going to try and buy the right property for someone but you're only working in a small little radius, it doesn't make sense. Like, are most buyer's agents, like how you do it, like you're looking Australia wide, or is there still a big cohort that will just focus on, particular suburbs and that's kind of like their spot and niche?
Yeah, you got a mixed bag. You got some that only focus on certain locations. You got some that are like me and look everywhere, and those locations will change. And then you got some that do a bit of both, jack of all trades sort of thing. It just depends on what the client needs. Like, for example, if you're looking for your family home and you're really keen on a certain pocket, right, but you don't have the time or the relationships or the expertise and all the other stuff that comes along with, what a buyer's agent can help with, it might make sense for that. But if you're looking for an investment property, it's all about the data, the numbers. You're not attached emotionally to a location, then we could be better. It really just depends on what someone is after, really.
Yeah, and I think it's a great point you mentioned there. It's something I always speak to my clients around. Like the statistics, I remember it used to be quite high. I don't know what exactly it would be now, but most people when they go out and buy an investment property, say they're living in a particular location now, they generally buy within a 40, 50K radius of where they live because it's like that familiarity bias. Like they're familiar with the area. You always think what you've got is like better than it actually is because you've got that emotional sort of bias in there as well. And it's one thing I always tell my clients, like if we're going to be buying investment properties here, don't think of it for something that you want to live in because that doesn't necessarily mean it's going to be the best investment decision. And then as a part of that, well, how do you remove the emotion from that decision? And that's where people then look at engaging, people, like you, Kevin, and buyer's agents in what you guys do. Because I think there's a lot of value in what you guys do because it's obviously a huge transaction. Like the biggest transaction most people are generally making is buying property in their life. It's not cheap. Like it's not like buying $1,000 in shares. Like if you get that wrong, it's only $1,000. But if you get a $500,000 or $1 million purchase or whatever it may be wrong, like that can really dent your wealth journey. And unfortunately, I've seen people, over the years, like apartments, I've seen so many people lose money on apartments and off the plan. And in hindsight, they know they should have done something differently, but they've held the property for 10 years and it's it's lucky if it's grown, and now they're looking at selling it and redeploying that capital elsewhere. So it's a great point to mention. But before we get into then some of the crux of it, Kev, do you mind just giving us a bit of insight of your backstory, and then specifically leading into the Kev Tran Group, which is your new business and that you've launched on your own? So give us a bit of backstory, Kev, about yourself and what's brought you to actually starting the business.
Yeah, of course. So previously, before becoming a buyer's agent, most of my career I was working in the casino industry. So about 10 years working out Crown of Melbourne, Star in Sydney, and I was in a role where I was looking after high rollers, really. They gave you fancy titles and all these names, like all these things, but the job was to get people to gamble more. So not like a great role that I could see myself doing long term, but I was there for about 10 years. And anyway, in that journey, in that role, I came across a lot of people with a lot of money, right? And it really changed my way of looking at money. And growing up in an immigrant family, we had very much like a scarcity mindset. As I've learned, saving can only get you so far. But anyway, I saw all these people like making good income, but then like kind of spending as well. But they always told me that they could make more money. Anyway, in that role, I had okay income. I started saving up, and I knew that I wanted to do something with it. So I was about 26, probably about 6 years into this career, saved up about it was about 60, 70 grand, and got into my first investment property. From there, started slowly building it out while I was working this career, and then COVID happened, and like most people, I think I just said, this is it. I've got to change career, otherwise I'll be doing this forever. And started becoming a buyer's agent, working for other people. Fast forward about 4 years or so, Kev Tran Group started.
Yeah, no, that's amazing. And buyers agents just in general, like, is that career or that industry, is it been around for some time, or is it, because I'm seeing obviously a lot more of it now, but buyers agents historically, is that always been something that's been around?
They've been around in Australia for a little bit of time now, but I guess the last few years or so has been become a much more popular option. Also because there's been a need for it. What I've noticed in the market, whether you're buying a family home, like we were saying, or an investment property, there are so many aspects to it. Like you said, it's a massive decision. Most people may buy one or two properties, if anything, in their whole life. So it makes sense. And also outside of Australia, it's been quite a common occurrence. In Asia, it's very common. In the US as well. Granted, like it's structured differently, but in terms of the buyer getting assistance, it is quite common.
Yeah, sure. And then talking about then what buyers agents specifically do and where you guys kind of fit into the equation, because I speak a lot to clients of mine around like having a dream team. So, you've got a financial advisor, which is usually us. You've got your accountant who's doing their piece. You've got a mortgage broker who's doing the loan and the structuring. And then there's you guys that fit in and do your part of it. So, well, what's the average journey look like for someone that wants to engage with a buyer's agent, for the service that you guys provide at Kev Tran Group? Like, what does that journey typically look like from beginning to finish, Kev, just to give us a bit of an idea?
So I guess the main things that we help clients with, probably like four main areas, I'd say. And often this whole journey being part of a dream team, I like to refer to it as well. There are many professionals that kind of going hand in hand and help out. But kind of where we help out here would be a property strategy, firstly, slash like a brief creation. So just being really clear on kind of what this actual purchase looks like, all the things considered. And then from here, what do you want to do longer term? Do you want to build the portfolio further? How aggressive do you want to be? Like, we want to understand, our clients' objectives so that we can best work out a plan for that. And along that, it's very broad term, but the second part it leads to is the which markets that you can invest in. So the market research that we have comes in as well. So they will have confidence where to invest. From there, we help with going out and sourcing and securing the actual property. So we buy residential and commercial. On the residential side, they are established freestanding houses. So no units, like you mentioned before. They've underperformed historically. There's a lot of issues as well with maintenance, body corporate, and all that stuff. I won't get into so much now, but we do houses pre-existing in really tight pockets across the country. From there needs to be a lot of due diligence once we find deals as well. So making sure there's no detractors, buying in a flood zone, main road, bushfire zone. We're making sure public housing thresholds are important and looked at. So all of that aspect, understanding what it's worth as well, valuing the property, looking at comparable sales, and then of course negotiating and going through that whole end-to-end acquisitions process. Right. And then the last thing where we kind of jump in would be the time. Even if we gave clients the whole blueprint of what we do, many are just like, I don't have the time to do this, so that's probably where we fit in, I guess.
Yeah, no, I can totally relate to that. And even for myself, like some people are surprised when I tell them I use buyers agents like yourself to help me buy property, but it's the time is a massive factor. And particularly for, busy, if you're a well-paid professional and, you got to think of, you're probably already poor on time, you've got kids, family commitments, and then you're going to try and figure out where to buy around Australia. Like you're going to fly to all of those places to see and do that due diligence. And that's where obviously you guys come into the fold and sort of, fill that void. But with the data side of things then, like how are you guys pulling all of that together? And is then what you're doing, is that purely then based upon the numbers of all of the research around Australia and all the suburbs and fundamentals and all those moving parts of it? Is it first and foremost like data driven, or is there any like overlay or aspect of, you guys as the experts that's, you might go against the data, or are you generally sort of sticking to the facts and the figures?
Yeah, absolutely. So it's very much a data-driven approach, but then we will also have the human element to it as well. So I'll explain what that means. So we kind of have the approach of a macroeconomic into the micros, all the way to the actual property itself, right? To kind of taking a step back to the approach that we have is, if you look at Australian property, there's a few data sources you can look at, which I'll go into in a second, but generally a lot of the data will show a very similar thing, which is over 90% of Australian council areas over the long term, like say 25 years or so, will have at least 5% growth on average, if we're looking at houses, so not units. And it's got to be in areas that have statistical reliability, so not too rural. If it's a town with only a few hundred people, you don't have the data there. But if it's like over 10,000 in population, generally we'll have a good amount of info long term about it. So what this tells you is, if you buy a house in Australia, it's not too rural, over the long term, 25 years or so, you'll do okay. All right. But the issue, as we know, it's not linear. It's not every single year you're going to get this amount of growth. Yes. And for most people, especially if it's for an investment, you may have an investment horizon as part of your plan. Or you want to, leverage property and the equity and the growth there to build more. So you don't want to buy a property and then for 8 years it's stagnant, right?
Yeah.
So how do we do that? Okay, cool. So firstly is houses that we look at, right? And the first part of the equation is to make sure you are buying in areas with a strong local economy, making sure there's diversity in different industries. We're avoiding mining towns. We're avoiding cities that have one industry that's their main thing, like tourism. It's too volatile for us. So we're looking at all this. We want to see what the unemployment rate is there, what the relationship between that and job ads. So it's going to be nice and healthy. How many owners versus how many renters are there? We want a predominantly owner-occupier driven market. It's going to be more stable, longer hold periods. Generally, they'll pay emotionally for properties as well. Out of those owners, though, how many people own outright? They won't be affected by interest rates, high living costs. Those that have a mortgage, then we look at how effective or not effective, how strong that income is against local property prices and therefore local mortgages. All right. So a bit of a side note there. That's what we call relative affordability. Really interesting thing that we saw during the most aggressive rate rises in history from May 2022 was markets that are very expensive or less affordable, Sydney, Melbourne, Canberra, Brisbane. They all saw a pretty strong reduction in price as soon as we had the high aggressive rate rises. Many other markets like Adelaide, Perth, strong regional cities, they didn't have a dip. They just continue to grow, right?
Yeah.
Partly due to people being able to afford high interest rates. We also look at infrastructure projects. So, what's in construction now, what's in the pipeline or planning stage. We want a good mixture of government and private spend, hospitals, different industries, all these things, right? So that's the first aspect, local economy. If that looks good, then we'll go to the second part, which is the actual property market. And what we're looking for here is a supply and demand imbalance, because we're talking about things like interest rates, immigration, all this stuff. They are important and they play a factor, but they're just one part of the whole equation of supply and demand. Yeah, so we're looking at this, and there's so many metrics that we can go into as well, but probably for another episode. But once we go into all this, we can have confidence about which locations we're investing in. And if you've got that pressure, then you can almost, you can actually see it live, like happening, that markets are growing, whilst other markets might be declining or stagnant. So.
Yes, and then it's a great point then. So it's like it's not any one thing that's driving that decision. There is like a multitude of factors and layers to what you guys are doing, which is where that's why I tell clients, like, there's so many more moving parts to it. It's not a matter of, interest rates. Like the expectation now is interest rates are at their peak and they're going to maybe start falling in the next quarter. The first quarter of next year is what the markets are predicting, but that doesn't necessarily mean that's going to be the driver of property prices. And then just because interest rates start falling, well, property prices are going to go straight back up because, like you were saying there, property prices have actually, in certain areas of Australia, have actually been growing really well over the last 12 months or 12 and 24 months. And that's all in the view of interest rates only doing nothing but rising. So it's always, there's a lot more moving parts to it. And I think there's a lot of value in what you guys do. But if people are then looking for a buyer's agent, Kev, I've seen before that there are buyer's agents out there that charge commissions or will work in with like developers and builders and take like a percentage. And then there's a cohort doing a fixed fee, which is obviously how you guys operate. But what I'm getting at there is, what do people need to look out for when, looking at buyer's agents? Like, are there any like rogues out there? Like, is every buyer's agent that would be advertising out there, are they licensed, or do people need to look out for certain things if they're trying to engage a buyer's agent?
Yeah, great question. And I often will say this to people as well, because I might have a conversation with someone who's interested in working with me, and they might say, "Hey, I want to speak to some other people." And I'm like, definitely do that. You want to make sure that it's a massive decision. Make sure you're comfortable with whatever you do. And then I will ask him like, "Hey, do you know these certain questions to ask?" And one of them is, you want someone that is exclusively paid by you only, right? So there's no incentive to do anything else that isn't in your best interest. And a main thing there would be getting paid by other people, right? Like a developer or something like that. So that's another reason why we only buy established. We don't buy anything new, and probably another podcast why we don't buy new properties. But ask your potential buyer's agent. It's like, who else gets paid here, for the purchase? Are you incentivized in any other way? One thing that you should note as well is to buy or to sell, I should say, new builds or new projects, you don't need to be a licensed real estate agent or buyer's agent. They're like project marketers. They're just a salesperson. They're just selling developer stock. So it's something to be really conscious about, because sometimes they call themselves buyer's agents, which I'm quite sure is illegal, but something to watch out for. Ask for the license details. If they're operating in different states like we do, ask them for their license numbers. Like we have all that available, and you can look it up online. But that's the main thing. And again, if they're getting paid by other people, that's good to know.
Yeah, like in any industry, there's rogues. There's always going to be bad apples, but it doesn't necessarily paint the whole picture of the whole industry. And financial planning is a great example of that. Like, we've been through a lot of regulation, and unfortunately, there are still some bad apples out there. But it's the key part is that you just want transparency. And like you said, if someone who you're going to work with can't actually clearly explain how they're getting paid, and what I mean by that is, I spoke to some buyers agents earlier on in the journey, and the way that they were telling me how they were paid through the builders' profits and things like that, it was just getting way too murky, and it was not clean. And I'm like, this doesn't make sense. I couldn't do it myself. There's no way I could hand that over to a client or refer a client on to go and work through them. And that's where I think the fee for service model is just clear, transparent, and like you said, which I think is worthy of another podcast. And there's a lot of things that we're going to be discussing worthy of another podcast. Like, you guys don't buy new builds. Like, you're not flogging house and land packages, which is like all the rage generally for first home buyers is the house and land package. So there's obviously a lot of bits and pieces to dig into that just alone. But what about what you're seeing at the moment, Kev? Like, is there any like trends that you're noticing, with buyers lately, like clients that are coming through to your business? Is there any trends? I know you obviously working with investors. They're obviously obviously just buying investments. But any trends you're seeing from clients coming through, repeat clients coming back? Just what you're seeing out there in the market at the moment.
Yeah, a few I'm seeing over time, no particular order. Of course,
Yep.
I work with you and your team quite a bit. We're seeing a lot of self-managed super funds come
Yeah,
through.
yeah,
That often makes sense for people with those larger balances. Um, we are seeing a lot of rent investors, especially in capital cities where it's very expensive to buy a house, like including for myself. For many, it may make sense, especially in certain stages of life, so we're seeing a fair bit of that come through. What else would there be? I think also there's been much more openness to buying in different markets, especially when you present the data the way that it has been presented, or the way that we do it, I should say, but also looking retrospectively. Because when we had the most aggressive, firstly when we had COVID, no one really knew what happened. But then obviously you look back and you go, wow, massive boom across the whole country.
Yep.
And then the most aggressive rate rises, post COVID, you're like, okay, cool, this is going to drop prices. It didn't, continued for certain locations. So I think after all that, people have a lot of confidence as well in certain markets if you look at the data.
Yeah.
So that's what we're seeing.
Yeah, and the rent vesting is an interesting one. I've done that strategy. I actually really like that strategy to an extent, and it always comes down to individual circumstances, of course. And the other one being, self-managed super funds is a lot of the work that we're doing at the moment for clients that have the ability and a sizable balance and tick a lot of the right boxes. Buying a property through a super can actually be a really good option, considering you could sell it tax-free after age 60 when you're in the retirement phase, which is obviously really, really appealing. But if we look at over the next 12 months, now there's no one's got a crystal ball, no one can predict where things are going to go. But do you, if I'm a client and I say, hey Kev, like if I'm buying a property over the next 12 months, what should I be expecting? Like what's your general view or consensus that you tell your clients around property interest rates coming down, what that maybe does to the property market? What do you say there, Kev?
Yeah, so it can be. It's a question that we're getting quite a bit. And one thing specifically that I do lead people to is, so we'll talk about so at this point, imagine we've had the strategy, you've got the holistic plan with them. We're talking about the property brief, all that stuff. And then we're talking about locations, all right? And one thing to note is, this is the balance of capital growth and cash flow we look at. It'll kind of limit which locations we like based on that local economy and all that stuff. So then we'll get a whole bunch that are left over that are based on, they can buy based on their brief, right? And then from there, they go, where do I buy? Like, there's so many locations. How do I know one's better for me? So that I put them in categories. I've got markets that what I would consider like maybe a little bit earlier or in their growth cycle, or they've had a boom already and maybe it's another kind of like another second wind coming up. And then you've got other markets that are right now experiencing a lot of growth. We call them hotspots. And there are pros and cons to buying in these markets. And what I am saying to people, what I reckon in the next 12 months, because of these interest rates on the very short horizon, and as we know, the major banks have already decreased their fixed rates, so they've already planned for this, is markets that are already superheated, I think it's going to be more chaotic. It's too crazy. But the markets that at the moment I'm considering to be these earlier markets, they have really low supply levels already. The demand is pretty stable and good, but what I can see is as soon as you've got something like interest rates going down, consumer sentiment goes up, borrowing capacity goes up, it's really going to kick off for many markets. So if you're in a position to buy emotionally and financially, it doesn't make sense to hold off because there might be opportunities now before the hordes come back in, because many people are sitting on the fence sort of thing, right? That's what I can see.
Yeah, it's interesting because it's like you said a lot, like all the markets are all doing different things at any one time. And that's where I think a lot of people get a bit confused with properties. They think they look at property as just one big thing and it's all going in the same direction. But like every state is doing something differently. And then you dig deeper into the suburbs and councils. Like they're all moving. It's like a share market. Like there's all these different companies. Think of the share market, but all the suburbs in Australia is like different companies and areas, and they're all doing something at any one time. And yeah, you can buy in the wrong place at the wrong time, and then you can lose money. But like you said, generally, and this is what I say to clients, if you stick to the fundamentals. You're buying a home. Some of the areas he said, like, rural areas sometimes might want to avoid. You're not doing apartments. Not saying you can't make money generally in apartments, but overall, longer term, it hasn't panned out that way relative to relative to homes. Off the plans and things like that. Like, there's a lot of basics that if you avoid them, you can generally do quite well with buying property. And I always get some people say, is like now the right time, like, and when's the right time, like, do I pick there, like, do you have people come through and say, like, should I keep waiting, do I keep waiting, like, to interest rates start falling, or do you ever have clients ask about timing, Kev?
Yeah, that's probably the most common question you get in property, right? Or like maybe investing in general, is now a good time to invest or to buy a property? And I kind of go through everything that we've just discussed previously. And if you were doing that during the COVID time, if you were doing that during post-COVID interest rates, in certain locations, of course, you'll be missing out on all this growth. So part of like my qualification process, and when I talk to people, is understanding if they've got obviously the capacity to, they're financially ready, and they've got like a buffer in place, because you don't want to buy a property and then it's like, okay, you've got no emergency fund or safety buffer. You want to make sure that you're comfortable. I'm like, well, your position, it looks really good. What is your concern? And they're like, oh, whatever, and then we can address it. But yeah, it's a common question for sure.
Yeah, and I'll use an example. Like the first property I bought, if I look back at the pricing history of the area and Australia as a whole, like I actually bought at the top of the market, and like I timed it totally wrong, but it wasn't a timing thing. It wasn't even on my mind buying the first property. Like we just wanted to get our first home, and then how long have we owned that property for now? We've owned that for probably 7 years, 8 years. We've owned that property, and in that space of time, it's conservatively gone up over 50%. And that's, if you look at all things being equal, like we literally timed the top of the market is when we purchased in, you know what I mean? But, it was a good house, standard location, just nothing out of the ordinary. And then we've just sat on it. And like, I love property as a long-term part of the portfolio. And that's where there is a major difference between property and shares, is the size of the asset you're actually acquiring, and the ability to leverage as well is the big difference. Well, that's always the key thing I go to when clients ask me, should I buy property or shares? I say generally both. It's always going to be both. But the one major difference is you could take $100,000 and maybe go buy a $500,000 or $600,000 asset if you're going into the property market. But if you're trying to do that into the share market, you take $100,000, you're typically just going to buy $100,000 of shares. And then you go back to the point you said earlier. If you take the view that average property prices 5 or 6% longer term growth rate, you throw on the income factor of maybe 3 to 4%, that's getting you into the 8 to 10% total return realm. That's exactly what the share market generally does longer term as well, from a growth and an income perspective. But the major difference is there is if you've got a asset of $100,000 worth growing at 10% per year versus an asset of $500,000 a year growing at 10% per year, those two situations are going to play out very, very differently. So I'm definitely a fan of both, but it always comes down to a balance as well. But Kev, mate, this has been great, and of course your business is only new and getting off the ground. Where can the listeners find you? And you're on the social channels, social media as well, Kev. What are some of the channels, and where can people find you?
Yeah, all the main socials. Website is Kev Tran, KEVTRAN.com.au. Or Instagram, probably a big one as well, Kev Tran Group. But yeah, on TikTok and all that stuff.
All the fun stuff. And clients coming through, do you just have like an initial, just like obligation-free chat to begin, or what's generally like first steps? If anyone actually did want to reach out and chat, what's the easiest way?
Yeah, so an initial chat, 15-minute phone call, and the idea here is really understand situation a bit further on the client side. Also on our, like, we can explain kind of what we do. Just understand if it is a good fit or not, and if it is, if it makes sense, then we'll do a longer video call where we can really dive deep into everything. And I was saying the main thing is to make sure it is a good fit, because if we're not, even if you came on board, we'll find out sooner or later. So we want to make sure that it is before we do anything else.
Yeah, and in closing then, Kev, any hot suburb tips for us? No, I won't do that to you, mate. I won't do that to you.
Maybe for another podcast.
Yeah, but another podcast. But it's actually something I wouldn't mind finishing on just quickly. Like a lot of people are talking about Melbourne and avoiding Melbourne due to the government and land tax and things like that. Like I don't want suburbs or anything like. But in general, Do you think Melbourne is a bad investment opportunity? Like, do you think you would, because of those factors, land tax and the government and other bits and pieces, like, do you see that as a complete red flag where you wouldn't invest there, or what's your general thoughts?
No, we're actively buying in Melbourne for clients. However,
There you go.
when I was talking about those categories, we are calling it an early market because the demand aspects aren't there, the metrics, I should say. But over the long term, Melbourne's actually been one of the better performing capital cities in the whole country. You know, if you take out the last few years, at some point it was averaging 8% returns for houses, which is remarkable, right? But like we were saying before, everything moves in cycles, and there are always little things, interest rates, land tax is a thing in Victoria that is not favorable, right? However, what happens with that is, and things kind of, again, work in cycles specifically around things that happen too, which is land tax, that makes it unattractive for a lot of investors to go in the short term. And when you don't have investors, you don't have rental properties. So when they sell off, which is what the trend we've been seeing, is that there are less investment properties, which means that current landlords who are holding assets in certain locations can charge more. It's just natural, economics. What happens then is your yields go up, your rental yields. So then now we're getting outskirts of Melbourne, 700K for a freestanding house, giving you about a 4% rental yield, which is unheard of a few years ago, right? For a capital city size of Melbourne. And then at some stage, if this continues to grow, if you're renting, it's not going to make sense for you to rent. You'd rather buy. So you're going to get internal demand. And then externally, as an investor, you're going to be like, well, you can buy population same as Sydney. You can buy a house in Melbourne at like, 4% yield, 700K. And there's no massive demand competition right now. So I could go in as a contrarian and play, beat people, and then the hordes will come, like we said, in cycles. So that's definitely an interesting thing. And then just we can talk about location quickly too. At the moment, this is something that a conversation I had yesterday with a client that came on board. They're very adamant of buying in Townsville. So I was buying in Townsville about 18 months ago, almost 2 years ago now, when it was an earlier market. It's a regional Queensland market. It's all over the media now. It's very hard to buy in right now. It's what we call a hotspot. Many markets have grown like 25, 30% in the last 12 months. Plenty of legs still left in its current growth cycle, but people have missed a lot of the boat, so to speak. So if someone is coming in there and they go, I want to buy in Townsville, I heard it's got great rental yield and great capital growth. I'm like, all right, cool. But did you know that your insurance is very high there? It's prone to cyclones and other things. Your council rates are also really high, right? It's like double sometimes what you can expect in Victoria. Then you go to Victoria and you go, hey, Kev, but I got land tax there. I don't want to pay land tax. Yeah, of course, but your council rates and insurance are much cheaper. So from a net perspective, now you're getting to around the similar from a cash flow perspective, but we could buy something with similar yields that isn't too competitive. So then when everyone else comes and joins and tries to buy in these regional Victoria markets like Bendigo is what I'm talking about, then you already beat them to it. So hopefully that's some insight into how we're thinking right now. But
No, I love it, Kev. That's a great way to finish, and I reckon there'll be some listeners a bit keen to talk more on off the back of that one. But guys, we'll finish it up today. Appreciate you taking the time to join us, Kev. Of course, if you're getting value out of the podcast, guys, 5 stars on Spotify and Apple. You can jump on the show notes as well to check out all of our social media channels. We do our weekly newsletter, and of course, we'll put a link in there to all of Kev's stuff as well if you want to reach out and have a chat with him. And if you want to chat with any of the advisors in the business, as always, just jump on the website and feel free to take your pick. But other than that, Kev, really appreciate your time, mate, and look forward to seeing you again on the Winners Playbook.
Thanks, Josh.